Okay, I think we are now live. We are excited here today to talk about the fantastic opportunities for protecting your patrimony, your wealth, as well as finding ways to reduce the tax bill. We have experts with us here at Barcelona Metropolitan. We're always thrilled to add value to the community. I want to take the moment right now to thank our experts on us with us. We have Sonia from Cuatro Casas, as well as Diego and Todd from London and Capital. Are you guys, can you hear me okay?
Yeah.
Okay. You know, sometimes I see that people are coming on board. I still see them coming on board. Do you want to give them a minute or two to before we get started so they don't miss anything?
Fantastic. Yeah, of course.
Sure.
Okay. Then we'll be doing that just now. And how are things? You're in London, Todd?
Actually pleasant and sunny, believe it or not. So we're having a good day after a washout weekend.
So you got to get here to Barcelona as soon as you can, Todd. We had a beautiful day. It was bright and sunny, your average Barcelona day.
Looking forward to it.
It was warm. And Sonia, are you also here in Barcelona, or are you calling from another part of the world?
No. Today I'm in Barcelona. Next week I'll be in London.
Okay. Well, I'm excited. You know, one of the things that is near and dear to the hearts of everybody who moves to Barcelona and thinks about moving to Spain, there are certain issues that are always really important. One of them is, of course, the issue of taxes. If you are an expat and you are lucky enough to make sure that you have some money, planning is everything, because you can get penalized, or you can start doing some transactions that are that'll get you into hot water. And also, there's a lot of myths and scares, but there's also some realities of dealing with the Spanish tax system, but dealing with Hacienda or the Internal Revenue or what do we call it in London?
The HMRC, the taxing
authority.
Yeah.
Yes. You know, it's always it can be nerve-wracking to get started. And as an expat, these things are really important. So I'm excited. This is going to add a lot of value to the international community here of Barcelona. Well, it's 5:05. If you don't mind, we can get started. I can see people already on and waiting. So if you'd like to, Sonia, I believe you're going to start off. Is that correct?
Yeah.
Okay. So here, I'm going to put up your presentation here, and then you can control it from there on out.
Okay. Let me see if I can control it indeed. I don't see I can really move them. So if you don't mind, Victor, I can see the bottom where I can do. If you don't mind, maybe you can move them around if you don't.
Absolutely. Not a problem at all. Okay, so if you don't mind, Sonia, if you can introduce yourself, and then we'll get into your slides here.
Exactly. Beautiful. So hi, everyone. I'm a tax partner at a Spanish firm called Cuatro Casas. Cuatro Casas is a big law firm with more than 1,000 lawyers. We basically are what we call full service law firm, meaning that we can do corporate tax, we can do, we can do corporate, we can do tax, we can do litigation, we can do immigration, although we usually do it with some partners, but we do some immigration work as well. We have labor law, we have real estate law. So we practice full service. That's what we law firms we say. And today I want to talk a little bit about the Spanish tax system and what Victor was saying. I think before moving to Spain or being in Spain, it's something that we maybe don't like to talk about, or we feel it's boring. Myself, I don't think it's so boring, but for some people it's a bit boring. But it's important to know what is the Spanish tax system, what obligations do I have, what penalties do I have if I don't comply? Because as Victor was saying, the Spanish tax authorities, it's a strong body with a lot of means and quite active, and it can be quite aggressive. So it is important to basically stay with the rules. So we move to the first slide, and then the first slide is about, am I resident in Spain? Because it might be that if you spend some time in Spain, but not the full year, maybe you are not Spanish tax resident, so maybe you don't have any obligations at all to comply with in Spain, or you have some obligations, but not the heavy ones as being for being a Spanish tax resident. So it's important to determine that, and for that we count days, and the rule is 183 days in Spain. And I always say that be careful if you are not a tax resident in another country, that the days that you spend outside Spain, they are going to count as Spanish days, unless you can prove your residency somewhere else. For example, a tennis player, Rafa Nadal, even if he's traveling all the time, he's still resident in Spain, because the days that he's absent from the country, those days, they count as Spanish days. So, I leave the UK, I leave the US. I'm not a resident there anymore. Maybe I pay taxes in the US because I'm a citizen of the US, but I don't live there anymore. I am not a tax resident. In that case, the days outside Spain, they count as Spanish days. So in that case, you could fall into Spanish tax residency, even if you don't spend 183 days physically in Spain. And by the way, Victor, Todd, Diego, if you have any comments, please interrupt me, and we make it more interactive. So fine with me. Then there's a second criteria that is basically if you have your main assets, you have them in Spain, then you are going to become also Spanish tax resident, because the center of economic interest is considered to be in Spain. So if you don't want to fall into that criteria, just call Todd, call Diego, and have your assets in London, have your assets in the US, and therefore you don't have them, no? Most of your assets are not in Spain, and therefore you don't fall into that possible residency situation. If you have children and a spouse resident in Spain, then there is a presumption that you are also tax resident in Spain, unless you prove otherwise. You can prove through different ways, but basically a certificate of residency in another country. Of course, Spain has many tax treaties to avoid double taxation. We have it with the UK, we have to the US. So it could be a situation where you are tax resident in two countries, in Spain and in the UK, in the US and in Spain. The treaty will say where you are resident. You cannot be resident in two places. Okay, and the first criteria to determine where you are a resident in the treaties is where you have a house at your disposition. So if you don't have any more a house in the US, you don't have any more a house in the UK, and you have a house in Spain, very easily you will be considered Spanish tax resident. And one thing that I'm asked often is, what about people who are studying in Spain? In the US, I think that there is a rule by which if you are only studying there, you don't become tax resident in the US. In Spain, if you are 183 days, even if the reason why you are in Spain is to study, you can become a Spanish tax resident. So those students, some of you that are listening are studying here in Spain, don't rely on that kind of rule that they have in the US, because maybe you are a Spanish tax resident. So moving to the next one, Victor. What does it mean to be Spanish tax resident? I cannot do anything else than become a Spanish tax resident. I like to live in the country, so I become a Spanish tax resident. Basically, it means for the talk today that you are subject to personal income tax, like you would be in the UK or in the US, for worldwide income and gains. Even if your portfolio assets that Todd and Diego are managing are in the US or in the UK, you are still going to be subject to tax in Spain. And the tax rates on portfolio income, dividends, interest, capital gains goes up to 28%. And on general income, what we call employment income, real estate income, that could be subject to tax rates, which are progressive up to 50% in Catalonia, 43% in Madrid. It will depend a little bit in the region where you are living. Of course, we have tax credits. If you pay taxes in the UK and in Spain, Spain will give you a tax credit for the taxes paid in the UK. We'll see a little bit of that. With the US, it's a bit more complicated than that. But basically, you pay taxes in, and that's why I say the UK as a non-resident, Then, for example, dividends, they are subject to withholding tax of 15% according to a treaty. Spain will give you a tax credit for 15%. You will pay for the difference. Okay, moving on. Wealth tax, and that's a little bit of the one that we suffer a lot when we talk to foreign people that think about moving in Spain, and it's a difficult one for people to understand because basically most of the countries, they don't have wealth tax. Wealth tax applies on net assets worldwide. So it doesn't matter where your assets are. Those are subject to Spanish wealth tax if you become a Spanish tax resident. And it's net worldwide assets, meaning that debt will be deductible no matter where the debt is. Okay. Basically, there are a couple of allowances where you have a house, for example, it has an exemption of 300,000 euros. There is also, every one of us, we have an exemption that varies between regions from 400,000 euros to 3 million. So meaning that above 400,000 euros, I might become subject to wealth tax. Above 3 million euros, I might become subject to wealth tax. So it really depends where you are going to live in Spain, that you will have some exceptions, some allowances on the wealth tax that would apply to you. Wealth tax applies, as I was saying, on all assets. There are few assets, for example, like pension plans, that will not be subject to wealth tax. The question, and maybe that's something that I also touch later on, but the question, for example, that often we have is, what about an IRA in the US? Is that a pension plan? If it is a pension plan, is it exempt from wealth tax? UK pension plans, employment pension plans, are they exempt or not from wealth tax? The position of the tax authorities, I already say that it's very restrictive. So they are saying that it does not apply the exemption on pension plans. We have, as a law firm, we have a little bit of different views. And we think that in application of EU law, we could defend that, that foreign pension plans should be exempt of wealth tax. It's also true that what it is a pension plan, it might be different in different countries. Everything we call, yes, it's a pension plan. Okay, let's go into details and let's see if this is really a pension plan or not. Tax rates are scary. On wealth tax, they can go up to 375% every year. And the problem is that maybe I pay 1 year and I say, well, that's fine. But when I have to pay it every year, it's a big amount. We'll ask Todd and Diego to really make a lot of our investments, no, to first pay the wealth tax and then have a little of a return, right? So it is heavy. And then there is a rule, a very important rule that Todd and Diego know very well, that basically it says in the wealth tax, it says that if you make little income, your wealth tax gets reduced in an 80%. And that's very important to achieve. What is income is everything except capital gains. So then what we try to do with people like Todd and Diego is to have portfolios that mostly they generate capital gains instead of dividends and interest, in order to be able to apply this reduction of 80%. Because it's a huge reduction. No? Then we are in rates of 0.3, 0.4, 0.5%. That still are an amount of money, but it's not as dramatic as 3.75. As far as I understand, in the US, they don't give you a tax credit for wealth tax paid in Spain. So it becomes, and in the UK, there is no wealth tax. So if we move, Victor, to the next one, basically it talks about solidarity tax. That it's a tax that was introduced by the Spanish government when some regions in Spain, they started to enact legislation by which wealth tax was not due. So then there was a little bit of arbitrage, or if you want, competition between regions. In some regions there was wealth tax, in some other regions there was no wealth tax, and basically tax authority, the government, said, well, I don't want this competition going around, so I'm going to impose a solidarity tax, which is a wealth tax with exactly the same rules. If you pay wealth tax in your region, you will not pay solidarity tax because there is a tax credit. But if there is no wealth tax in your region, then solidarity tax will apply. And that's why, for example, regions like Andalusia and Madrid that didn't have wealth tax, now they have reintroduced their wealth tax again. Because if you don't have a wealth tax, the state still taxes your taxpayers and keeps the money in the central government. If you have your own wealth tax, then the money, your taxpayers, they still pay wealth tax, and the money stays in the region, and they can use it for whatever they need. So the idea is maybe just for people to know, sometimes they read, well, there is a wealth tax and there is a solidarity tax. That's a double tax. No, one gives a credit to the other one, so there will be only one tax. And the rules are exactly the same thing, and they have the same limitation of the 80% that I was talking about. I made an example. I think this next slide is an example. Yeah, fantastic. That how wealth tax would apply in a net wealth of 4 million. There is a person in Catalonia, and I put two examples because the limitation that I was talking about, it works a little bit different in the two regions. In Catalonia, you would have the personal allowance of 500,000 euros, which in Madrid is 700,000 euros. Applying the tax rates of wealth tax, it is 24,000 euros. And because Catalonia applies wealth tax, there is basically no wealth tax. No solidarity tax. So it's in the numbers of income 100,000, net wealth of 4 million, the wealth tax to be paid would be 24,000. If the limitation I was talking about would fully apply, basically that person would not make income but would make gains. The limitation reduces the wealth tax to 8,000 euros. So that's something, no? The idea here is that if you are living in Spain or you are thinking of moving to Spain, that you really take care on understanding and your financial advisor to understand how this limitation works, because it is very effective to really put down the tax cost of wealth tax. Okay. In the case of Madrid, the numbers are much lower. As you can see, basically, you end up paying only 900 euros instead of 24,000, because the limitation works a little bit differently. I don't think I have now the time, and maybe it's a little bit too complicated to understand, but just for people to understand, there is still wealth tax, but the limitation works in a little bit of a different way, and then the numbers of wealth tax can be much lower. And this only happens in Madrid. The way it has been introduced, the wealth tax and the limitation between income tax and wealth tax, Madrid is the only region that works in a particular way that is very, very favorable to the taxpayer. Okay. And in Barcelona, so it's not that I really want to make publicity about Madrid, but well, I think it's relevant for people to know. Other things, if we move on, Victor, inheritance and gift tax in Spain. In the US and in the UK, the way that inheritance works is that the estate is basically who pays the tax, and is very much related to where the deceased is resident or is domiciled. In Spain, what is relevant is who is acquiring the assets in an inheritance. And that person, if tax resident in Spain, is going to be subject to Spanish inheritance tax, no matter where the deceased was a resident. If the beneficiary who receives the asset is not resident in Spain, then only there will be Spanish inheritance tax when the assets inherited are Spanish assets. So if you receive, basically the idea is if you receive an inheritance when you are tax resident in Spain, then there will be a Spanish inheritance tax. We will be able to credit taxes paid abroad, paid in the UK or paid in the US. And in many regions in Spain, gift and inheritance taxes are very, very low. So again, Madrid has very low inheritance tax. Baleares, the Mallorca has very low inheritance tax. Andalusia has very low inheritance tax. So it's really a matter of looking in what region you are. But it's funny, no? I think it's also important to understand that it doesn't really work the same way. In the US or in the UK, what is relevant is where the deceased was domiciled or was resident. For us, it's more who receives and where that person is. Okay, and I see, Victor, I see gifts between spouses or joint owned accounts. In the US, it's like, yeah, no problem. I put them in both names. And this is all together. Gifts between spouses in Spain, they are subject to tax. So be careful with those movements. In many regions, gifts between spouses, they benefit from a relief of 99% or 100% of the tax. So basically they don't pay taxes, but they have to be done in a public deed. So if formalities are not complied with, the taxes go much higher. So important that in many countries, gifts between spouses, it's like no problem. For us, it can be an issue. So be careful with that. Moving on. Thank you. Victor was saying, maybe he has suffered some of that, or he has heard people with that. We have many reporting obligations. Well, in the US, you have the FBAR as well, so it's not that we are the only ones. But in Spain, there are several reporting obligations on Spanish assets and foreign assets to be complied with. One is called the ETE, which is more for the Bank of Spain. The 720, which is the more equivalent to the FBAR, that it's an informative tax return that gives tax information, but it's not about tax due, but gives information to the tax authorities on foreign bank accounts, foreign portfolio assets, foreign real estate. The penalties for this form before, some years ago, they were huge, they were amazing. Right now, they are much, much, much lower, but well, it's a form that still needs to be complied with. And then we have the personal income tax, wealth tax in Spain is due in June. That creates sometimes, especially with the US, it creates a little bit of a timing issue in the sense that you in the US, you can extend, no? You can, I think it is April, but then you can extend when you file your taxes to October, I think it is. And then, but we have to submit in June and we want to apply tax credits. So no, it's a matter of working with your lawyer, your CPA in the US in order to see how we apply those tax credits and the best way to do the filing in both jurisdictions. And then solidarity tax is July 31st, because then you see if you have paid wealth tax or not. If you have not paid wealth tax is when you pay basically the solidarity tax. So that's why it's 1 month later. In the US as well, we find a lot of timing issues with the K1s, with reporting of private equity funds, that it comes much later, no, than what we need, which is June 30 or even March for the 720. And that also creates issues. Okay, so moving on, Victor, thank you. One way to solve especially wealth tax being paid in Spain is to try to apply what we call the Beckham Law, and we lawyers, we call the impatri regime. This is a regime that basically if you move to Spain to work, and it's a big concept to work, and there are several alternatives that I'll discuss briefly. For 6 years, you benefit from a very interesting tax regime. For 6 years, you only pay taxes on Spanish income and worldwide employment income. But everything that would be portfolio assets, dividends, interest, capital gains made in my US portfolio assets, in my UK portfolio assets, they would not pay any taxes. And for the wealth tax, it's exactly the same thing. You would still pay taxes on Spanish assets, but not on foreign assets. And this is for 6 years, the year that you arrive and 5 more. A lot of people in the market, they say it's 5 years. No, it's the way it's written, the law. It says the year you arrive plus 5, so meaning 6 years. Okay, and for example, no obligation to file forms which are paying like Form 720. Okay, moving on. When do you qualify for this fantastic regime, which for UK purposes, it is a very attractive regime because I stop paying taxes on my worldwide assets. With US citizens, because you still pay taxes in the US, maybe it's a little bit less relevant because you still do not avoid worldwide taxation. You just pay it in the US instead of Spain. But you do solve wealth tax, the issue that we were discussing on wealth tax. So it is worth it to look into the possibility to apply the regime. The regime, it is basically that you move to Spain to be a director of a Spanish company, be an employee of a Spanish company, or work remotely for a foreign company. And we see that a lot. For example, if you are employed by a US company, a UK company, and your employer allows you to work in Spain remotely from your place in Spain in Ibiza, you could apply the regime for 6 years. You basically would be non-resident in your country of origin, and you in Spain would pay very little taxes. So we see that option, the remote workers, a lot. It does not apply for what it would be self-employed digital nomads. That's a possibility that we have for immigration purposes. So if you basically are self-employed and you work in Spain as a consultant, as an independent contractor, you could apply for a visa to live in Spain, but you could not qualify for the Beckham Law. The Beckham Law with people who are self-employed, it's very limited the possibility to apply the regime because you need to basically mainly work with the Spanish startups, with the Spanish very small companies, or be in the research, development, innovation activities, which in many cases it is not the case. Setting up a Spanish company which invests, which carries out an activity and be a director of that company would be a good option. So basically the idea is that you need to move to Spain to do a business activity. If you are moving to Spain because you just like the country and you are maybe semi-retired, those cases will not fit into the Beckham Law. And then when it is Spanish income or when it's subject to Spanish taxes, the taxes on employment income are lower than what it is for us, ordinary resident, is basically 24% up to 600,000 euros. Savings income, it would be the same tax rates that we have, but it will be only on Spanish source income. If we move on, I think I'm doing fine with time. I have a couple of slides on things that we encounter in cases that we work. With the UK, I think it's easy because basically when you choose to be resident in the UK, you become a Spanish tax resident. You are only going to be taxed in the US, in the UK, when you obtain income there. And for example, I would say rental income. You own a house in the UK. That rental income is subject to UK taxes. In Spain, we can apply a tax credit for the taxes paid in the UK. That's very clear. The treaty provides for that kind of tax credit. The thing with the US is that because you are in the situation where we have US citizens moving to Spain, they keep paying taxes in the US, not because it's a non-resident that obtains income in the US, but just because they are a citizen of the US, which is a little bit of a nuisance. Meaning, for example, interest, if I'm a non-resident, so me, Sonia Velasco, I'm not a Spanish citizen, I obtain interest in the US, they are not going to be subject to tax. For me, they are not subject to tax, even if they are obtained in the US. So I don't pay taxes there, I pay my taxes in Spain. When you are a US citizen, you still pay taxes on those interests, unless they are mutual, how do you call them? Mutual interest, municipality bonds, right? But general interest, as a US citizen, you would pay taxes in the US. So Spain says, well, I don't give you a tax credit for a tax that you are being imposed in the US, not because you are non-resident obtaining income in the US, it's because you are a citizen of the US. So according to the treaty, and this is very clear in the treaty, who has to give a tax credit to avoid double taxation is the US, and it's not Spain. So therefore, be careful when doing your taxes in both Spain and the US, who has to mainly apply tax credits of Spanish tax to avoid that you pay 2 times taxes. I think that we are all in the business of paying taxes, but not being subject to tax twice. So who mainly will have to give your tax credit is the US in your tax return in the US, and not in your tax return in Spain. Except for dividends, which the treaty, Spain, the US, says that basically there can be a withholding tax of maximum 15% in the US, and on that we'll give a credit in Spain. So that's one point that I think it's very relevant for people to understand, not to be double taxed. And then a couple of more issues that I had in the next slide, Victor, were about people working from Spain remotely for their US employer, being self-employed, all your clients in the US, all your clients in the UK. That means that you are working from Spain, so you have Social Security contributions, obligations in Spain, you or your employer, it really depends on the situation. Penalties are quite relevant for Social Security, so people don't realize that when working in Spain, from Spain, you are subject to Spanish Social Security contributions. You may be even subject to Spanish labor law, and that has an impact in employers. Trusts, they are fascinating. I like trusts very much. It's a really good way to organize wealth and to pass it on. I really think it's fantastic. We in Spain don't understand trusts at all. The tax authorities don't understand trusts at all. And what basically say is, well, trusts are not in our legislation, they don't exist. So therefore they look, but it's still, there is some wealth there that they want to tax. So basically it is, who is deemed to be the owner of the assets? Is it the settlor, the grantor? Is it the beneficiary? But one of the two will be considered to be the owner of the assets. And this has an impact in income tax, tax credit, who pays taxes and who gives a credit to avoid double taxation, and it has an impact on wealth tax. It has an impact in inheritance and gift tax as well. So don't think that because you have assets in a trust, you don't have to declare them. You have to declare them, you have to report them, you have to pay taxes on them. With pension plans, I already know, I gave a little bit of a spoiler there, that I have my doubts that, well, the tax authorities basically, they say that wealth tax exemption on pension plans does not apply. I think that there are legal grounds to take a different Is that employment income or is that savings income? And there is a big difference in tax rates, we saw. So that's something that we also see in pension plans. Buying real estate in Spain, fine option. You can buy it directly or indirectly. In most cases, you are still going to be subject to wealth tax in most of the cases. So this structuring of two companies owning Spanish real estate. We see less and less of that, although there might be some situations where it makes sense. What I wanted to point out, that I don't think it's always the case in the UK and the US, is that if a property is owned by a company, the company has to charge market rent to whoever's using the property. And that sometimes it is an issue. The company will pay very little taxes because there will be depreciation, which is deductible. There will be for example, the property tax is deductible, but there is cash flow that has to be paid. There is, and the rental has to be reported. So, and we see sometimes people not complying with that. And the Spanish tax authorities are quite active in looking into Spanish real estate companies, so companies that own real estate in Spain, and making sure that rental income is being paid. So with that, I think I made it even too long. Thank you, Victor. Todd, I will give you the word.
Well, there you have Sonia Velasco, a extremely respected person here. When you're talking about taxes, you're a legend, Sonia. So thank you so much. I think that adds tremendous value. Moving forward, Todd, are you going to step up, or does Diego go first?
Diego's going to go first.
I gotta go. Well, first, many thanks. Yes, many thanks, Sonia, for your helpful presentation. I think that it's important, these considerations when moving, no? Well, myself, Diego Pájaro, I'm an executive director for our Spanish office in Barcelona. I work in the industry for more than 20 years, the financial industry. I started in big banks, then as a financial advisor, and I'm always enjoying the investment strategy and also the relationship with my clients. I'm also an expat who faces the challenges of moving to another country and setting up the office here in Spain with all the regulatory matters that Spain has. So I know how stressful it can be, no? And find the solution for these problems is the key. Well, I will start my presentation of the wealth management consideration for expats in Spain. I think I can move the slides. So first, you need to know us, London and Capital. We are an independent wealth manager with more than 35 years of experience managing global private client portfolios. We started in 1996 with UK residents, and in 1989 with US expats, and later with European residents. We have a staff of 130-something members based in London. We manage more than $7 billion in assets with different custodians globally. We have custodians in UK, in the US, in Luxembourg, in Switzerland. And we have a unique proposition because we are regulated by the FCA in UK, by the SEC in the US, and the CNMB in Spain. This is why we are cross-border. We can cover the clients anywhere that they need to report. We have our offices in London, headquarters, an office here in Barcelona, where myself is right now, and we have an office in the Caribbean in Barbados, and our expertise is giving advice to international and cross-border clients. I go on with my. Well, when we opened the offices in 2021 after Brexit, we need to continue providing yes, our clients the service we provide always, no matter where they live in Europe. One of the partners of London and Capital, Pau Morilla Giner, he helped us to establish the company in Spain with the same values and standards of our London office. And we keep serving mainly the UK and US expats, as well as some Spanish families that we have, and obviously some Latin American families. So I go on with my, well, what do we do? We have 3 pillars. One is the financial planning, where we look at client entire financial picture and advise on how to achieve their short and long-term financial goals. On the other side, we have the investment management. We have a team in London who specialize on our investment proposition itself. We are not a bank. We are flexible on our proposition. We don't sell products, and we understand that the client will need some differentiation going on with the specific with the tax matters, no? And the third one, and I know that here Todd gets fascinated with, is the consolidated reporting, where the client has a global view of their assets, and he will explain shortly, obviously. So if you are in this webinar, maybe you're planning to move to Spain, or you are actually living in Spain, no? So our main goal as a professional is that you know how to invest your assets in an efficient way. You need to understand what are the problems that you will face, and well, we help you on how to preserve this capital, but also increase it efficiently, no? As Sonia explained, today there are conditions for US and UK to move into Spain. Obviously, we have sunny days most of the time, and beaches nearby. But our intention is to provide you solutions for those investments. No? I think that clients don't need to go crazy on learning laws or regulations, because there's also a lot of misinformation, that they just need to have a trusted person and that help them to guide them and to make all this process to resolve all these steps, or to follow these steps to make all the process going on. No? Todd, I will let my colleague and friend Todd to explain more about the challenges for the international expats in Spain.
Thank you, Diego. And yeah, perfect. Victor, if you don't mind pulling up my presentation so I can drive. But in the interim, what I'll do is a brief introduction. It's great to be with everyone. As I mentioned, my name is Todd Cowen. I'm an international private wealth advisor. I spent over 20 years in private banking in the United States with firms like UBS and Citibank, and moved to London 6 years ago, where I really started working more with cross-border Americans and international Brits relocated abroad. About 6 years ago, I started doing a lot more work helping UK and US expats relocate into Spain. And so I've been kind of charged with the geographic expansion of London and capital with respect to Brits and Americans moving to Iberia. So Spain, Portugal, Italy. But largely, passionately, Spain has been where I focus most of my time. As Sonia very, strongly illustrated, there are a number of considerations and potential tax challenges when relocating or living in Spain, and as my colleague Diego just mentioned as well. And so what I thought I would do is spend a couple of minutes talking about the landscape for expats, internationals, as well as some of the considerations that you might want to undertake. So what makes it such a challenging landscape for expats? And this is, it's kind of regardless of whether you're a Brit or an American moving. And it's largely down to the lack of harmonization in the legal and the tax frameworks. And as Sonia mentioned, yes, there's a treaty in place, and that treaty is meant to reduce double taxation as much as possible. But because of the lack of harmonization, it very infrequently does it eliminate the concern for potential double taxation. Mm-hmm. Oftentimes, there's a lack of understanding. So whether you're at the individual level, or maybe even sometimes at the advisor level, the lack of understanding of the multi-jurisdictional requirements that clients have. And if you lack that understanding of their requirements, then you can imagine that moves on to the next bullet point around suitable advice. So advice when it comes to cross-border, whether it be financial services, tax, or legal, historically has been very provincial, meaning that people can be very, very good at providing advice within their domestic framework, but the minute there is another taxing authority, legal framework, or investment landscape by which to take into consideration, the advice may no longer be as suitable as it was. And then I think in my, the last 6 or 7 years, as I've started to do more cross-border, specifically in Spain, and gotten to know, such a wonderful professional like Sonia, it's become very clear that there's also can be a lack of consistency when applying the tax treaty against an individual position. And I don't mean lack of consistency at the individual attorney level. I mean lack of consistency across perhaps Spain as a country, and from a tax attorney to tax attorney. And so what that really beckons is the requirement for you to make sure that you're aligning yourself with somebody who's well-versed, professional, and understands how to apply it. And ultimately, once they do apply it, are in a position to fight for you and explain their thesis and their application of the treaty, should there ever be, a phone call. And so, again, I think that's a tip of the hat to Sonia and her understanding. But the reason I mention all this is because all of these points contribute to an environment that can lead to vagueness, maybe create confusion, again, at the client level and even the advisor level, and can ultimately lead to unforeseen consequences. So who's impacted? I think this is a kind of a nifty slide that shows that from European expats, so maybe somebody, like from the Netherlands relocating to Spain, to an international expat, perhaps a Canadian or somebody from the Middle East or Asia relocating to Europe, to the UK expat, to the US expat. And what it shows is the more you come down the funnel, the more restrictive the landscape gets in terms of the nuance of investment, as well as needing to navigate tax. And so you'll see the considerations in terms of investment suitability, tax treatment, reporting requirements, and advice suitability. Interestingly, I probably, prior to Brexit, could have flipped the UK expats and the international expats around, but given that there was no financial services agreement within the divorce arrangement between the EU bloc and the UK, it started to make the bifurcation of services and ultimately perhaps reporting and passporting a little more restrictive, and therefore, I believe UK expats kind of fall below the international expats. So again, long story short here, the more you funnel down, the more restrictive and the more attention needs to be paid in terms of the advice that the individual is getting. This is going to be a little bit of a content-dense slide, but ultimately this is the wealth management considerations. Again, not an all-inclusive list, but one that I think really illustrates what it means whether you're a UK expat or a US expat and the different considerations. And we can break these down into pre-arrival planning and post-settlement planning. Obviously, there might be a little overlap because you'll want to make sure that you have a consistent view against these. But when I think about pre-arrival planning, I think about custody considerations. So again, I can make the case for post-Brexit. If you're a British expat and you're moving to Spain, you'll probably start to see a little bit of friction between your home bank or financial institution in the UK and their desire to deal with you being an EU resident client. They may not have the permissions in place to maintain that relationship. The same can be said for the US, where over the last 10 years, maybe 12 years, in the wake of FATCA legislation, there started to be a number of US financial institutions in the form of broker-dealers, investment management firms that started to back away from Americans that were relocating abroad. And I lived that firsthand working at UBS in the 2010, 11, 12 timeframe. Moving on from custody consideration, and again, if you're going to want to identify whether your existing financial institution will continue to deal with you or whether you're going to need to find a new home for your life in Spain. In terms of account structuring considerations, I think this is an important one because, as you can imagine, and Sonia rightfully pointed out before, not every account structure that you onboard with in your home country is recognized in Spain. So you're going to want to have a think about what type of account structuring you have, and this could be everything from the IRA that Sonia mentioned to a Roth IRA to the trust account that she mentioned. For Brits, it could be your investment savings account, your ISA, maybe even your SIP. And so again, not all account structures are recognized the same between the different jurisdictions. So having an understanding of what you're currently in before you move, and what might need to have a special lens put on it. Maybe you need to do a little restructuring, but just not being caught out by thinking that the 529 plan or an annuity or even a certain life insurance policy is going to carry the same features and benefits once you're resident in Spain. I think these are important considerations. In terms of tax planning considerations, I'm going to go a little bit off script from what Sonia, but the good thing is that we do have a lot of consistency in what we shared too. One of the first ones, and I have an exhibit right behind this, is around portfolio management and currency gains. I don't think this is often talked about, but what I have here is the idea that, you know, if you are an American and you relocate to Spain, you will have, and you are a Spanish tax resident, you will have two taxing authorities. The U.S. will continue to expect that you report, worldwide income in a dollar format, and Spain will expect you to report worldwide assets in a euro-based format. And so what that can mean in terms of, a portfolio consideration is the potential for portfolio gains. And so I have two different examples here. The top one is a US dollar investor with euro-based reporting requirements, and the second is a GBP in base currency with euro reporting requirements. And so what you can see on the top is if you had purchased an investment for $500,000 back in 2021 in dollar terms, and you sold it for $490,000, like fast forwarding, I think to roughly call it autumn of 2022, you could have booked a $10,000 loss. And so, you may not be pleased that you had, over the course of 18 months, you had a loss in the portfolio, but you can maybe carry that loss forward, in dollar terms. The unfortunate reality is that given what happened between dollar and euro during that time frame, you could effectively have a 96,000 euro gain on that investment where you've made no money. And so ultimately needing to report that to the Spanish tax authorities, you might have a gain. Is that fair to say, Sonia?
Yes, that's the general rule. Absolutely.
Yes.
If the taxpayer basically has all his or her portfolio in US dollars and reinvests in US dollars, a position can be taken, and there are a couple of tax rulings that the way to compute your gain also for euros is to take the gain, so the minus 10,000, and that is what you convert into euros, and you put in your tax return, you will put a loss of 10,000. But it is really people that would have most, I would say, the whole portfolio in the US and would always trade in US dollars.
Right. Thank you for that clarification. I also think the other thing that's important, it goes back to what I said, that it would be important to have somebody like Sonia who understands the difference, in that application, because it may not be widely understood. And without belaboring the point, I mean, the same shows in GBP here. So where there was a scenario. So I'm going to go back here. And when we think about one thing that we didn't really talk about in Sonia's presentation, but it feeds into the investment management, wealth management, and it's the idea of pre-arrival planning, capital gains, asset rebasing, the potential to possibly realize some gains in the portfolio at a lower capital gains rate prior to becoming a Spanish tax resident, where the capital gains rate can be progressive and progressively higher. Now, I don't necessarily use this as an opportunity to say, hey, let's realize 100% of your portfolio's gains, because, the market goes up and it goes down. So there may always be the opportunity to offset in the future. But one thing, and again, Sonia, you can correct me if I'm wrong on this, I don't believe that loss carry forwards would apply, loss carry forward once you are Spanish resident. So if you do have losses in the portfolio, you're going to want to utilize those before you become Spanish tax resident against gains. So, and then the other component around this is wealth tax consideration. And as an American, and a number of people that I speak to, given the fact that so often we have the concept of married filing jointly, people think of wealth tax as this headline number of either the 2 million or 3 million. So a couple, that has 4 million, all of a sudden, they throw their hands up and they're like, I'm moving somewhere else, or this, I can't handle it. But I think it's important to mention that wealth tax is a very individual, a personal tax that is assessed. Therefore, with the proper structuring of assets, and as Sonia mentioned, you don't want to do this after you're tax resident because gifting challenges could come into play. But before you arrive in Spain, equalizing wealth to the degree that you can, trying to, again, spread assets away from one spouse that may have a wealth tax consideration to the other could be another solution and a consideration. And entitling investments and accounts properly, I think it goes towards that. So I don't know if you.
Yeah, I completely agree.
Yeah. In terms of income and currency considerations, I think one thing that is important is the idea that as Americans move to Spain, your expenditure is going to be in euros, and historically it's been a stronger currency. Albeit right now, it's a great time to be a dollar, I guess, earner or dollar holder spending in euros because it is at a relatively, lower point. But if you do believe that it would strengthen back to some sort of mean, and it was back to 113 or back to, even 120 at some point in the future, you're going to want to have a think about what your income and currency considerations are going to need to be. So you can manage portfolios, so you can manage your investments to keep pace with maybe a stronger currency than what your base currency is. And there's obviously lots of ways that you can do that. You can actually invest in a multi-currency portfolio to give you a little bit of buffer. You can do forward contracts. You could have an adaptable budget. There's lots of ways to, but I only mention it because you're going to want to be mindful about spending in a stronger currency. Luckily for the Brits, with sterling based, it's a bit of a stronger currency. And so you only have that challenge. But as we've all seen, sterling has been quite volatile in the wake of Brexit. And you don't want to discount what a depreciating sterling might mean to your overall plan. So moving on to banking, investment, and liability considerations, I think it dovetails back into custody consideration and ultimately finding a financial institution that is willing to work with you whenever you have maybe a cross-border lifestyle. So, in the U.S., will your bank continue to hold a current account or a checking account for you? In the UK, same question. Will HSBC or Barclays continue to bank with you? And in my experience, a lot of these institutions are starting to ask individuals to find a different solution. When it comes to investments, the same thing. Will you be able to maintain your current strategy? If not, what does that mean? Does it mean that you're going to be forced into the selling down your assets because your new provider can't take on your existing assets, or maybe they're proposition limited by only holding a certain investment structure? So these are things that you're going to want to think about. Ideally, understanding what investing across multiple taxing regimes might mean. And then the last in this component is really liability management. Do you have the requirement for borrowing off the portfolio? Wouldn't necessarily advocate for it in the current interest rate environment, but portfolio borrowing can be a very powerful tool when interest rates are lower. And is there an option to borrow in multiple currencies? The one thing I would mention here is the idea of a phantom mortgage gain. It's not often talked about, but I've spoken to a number of Americans, move to Spain, decide to buy that Spanish property, get a really great rate in euros relative to a dollar-based rate, and it only takes a small two things. It only takes a small move on euro to kind of wipe out the competitiveness of that rate. But more specifically, as if you're an American and you have that dollar-based reporting requirement, should you repay that loan with less money in dollar terms, there could be what's called a phantom mortgage gain from a U.S. perspective. So that's just one thing to consider. Retirement planning considerations. This kind of goes back to what Sonia was talking about in terms of the Spanish treatment of your pension, whether it be a 401k or an IRA, understanding that a Roth IRA is not going to be recognized in the same capacity as it is in the US, and you'll want to have a think about what that means for not only the underlying investment structures that you have in there, but also when the sequence of maybe drawdown, and how and when you take assets from certain pots. The same goes for workplace pensions in the UK, SIPs, potentially QROPs, qualified recognized overseas pension, if that makes sense. But again, Roth IRAs, ISAs, 529 savings plans, trust accounts, health savings accounts, certain insurance policies. These are all things that you're going to want to look at because they may not have the same benefits that you purchased for, and you just don't want to get caught out. From a Social Security perspective, understanding the windfall elimination provision for Americans. So, will your Social Security benefits be haircut because you have maybe untaxed pension benefits from another jurisdiction? I see this a lot with US, UK individuals that have benefits accrued in both jurisdictions. State pension contributions and considerations for Brits. And again, tax efficient withdrawals. So strategies for maybe the sequence of account drawdowns, where to take money when you need it, given the fact that certain account structures don't have the same benefits. So these are things that you're going to want to have a think about. Clearly, you can talk to myself or Diego. We can help structure a plan for you to address these things. When it comes to post-settlement planning, portfolio management and punitive taxation. So this is, I can't believe we've waited almost an hour to get into the PFIC, but here we are. So the four-letter word and four-letter acronym when in cross-border investing, especially for Americans, is the passive foreign investment company. And the reason we bring this up is because for Americans living abroad, this is your no-no. This is what you want to stay away from. It's effectively any sort of a collective financial instrument, meaning think of a foreign mutual fund, a mutual fund that might be registered in Luxembourg, or a mutual fund that might be registered in Ireland, or an ETF or private equity. Anything that does not report to the US, to the IRS, could be considered a PFIC, and therefore be subject to the highest marginal tax rate in the US, 37%, plus a punitive tax in the form of a penalty depending on how long you held it. So without going into deep specifics, just be aware that if you don't have investments in your portfolio worldwide, whether it's in the US or overseas, that report to the US in a compliant fashion, this could be very much a challenge from a tax perspective. And I usually give the example that if you buy one of these for $100 and it goes to $200, congratulations, you've doubled your money. But upon selling it, the first thing the US is going to do is they're going to take 37%, and they're going to ask how long you held it, and then they're going to assess a penalty based on that holding period, and that could be up into the remainder of that gain. So that's not a great result to basically be giving back an entire gain to the IRS just because you came across what looked like an attractive investment. And so the reason I mention that is because not only does it come in the form of unqualified investments, but it could also be unqualified account structures. There are certain Spanish account structures that may be offered at the local bank. It may be offered in the form of a pension that could ultimately be problematic. Touching on the UK side, the same rings true if you do have a foreign investment, meaning a non-UK reporting investment that was purchased maybe in Spain or in Europe, and then you find yourself with a reporting requirement back in the UK, so you're still holding it once you move back to the UK and you sell it. That's called offshore income and gain treatment, and that's subject to a top rate 45% tax. So again, in both of these instances, neither one of them are offering capital gains treatment, and you'll want to be mindful of that. And then the last thing I'll share here is just reporting requirement considerations. So, as we talked about, as Sonia talked about, when you're an American for life and a taxpayer for life, subject to you expatriating and giving up your U.S. citizenship. Therefore, you have the ongoing requirement to file U.S. taxes, and you need to do that in dollars. With respect to the UK, to the extent that you have UK reportable income, whether that be employment or rental income, as was mentioned earlier, you'll have a requirement there. When it comes to Spanish reporting, Sonia was very clear in the foreign transaction reporting, Modelo 720, 714, 760. These are all things that will need to be considered and will be your requirement and to be done in euro. And you ask, but Todd, why are you bringing this up? And I will tell you, this goes back to Diego sharing how I get excited about reporting. So at London & Capital, every account that we manage, we provide 2 tax packs. We provide reporting in your home country currency. So if you are a US expat living in Spain, regardless of whether we have an account held in Luxembourg in multi-currency or whether you have accounts in the US in multi-currency, we will provide you a dollar-based tax pack in the form of a 1099, 1099-R, 3520 for you to take to your CPA or tax advisor and file your taxes seamlessly. If you're in the UK, we're going to provide you a sterling-based tax pack from April 6th to April 5th with every single investment I just mentioned converted into sterling. Where things get really cool, and this is why Sonia loves having me in her office, I'm kidding, is because from a Spanish perspective, every account we manage, whether it's in Luxembourg or in the US, and more specifically, this is relevant to US, we are going to provide euro-denominated reporting with Modelo 720 and foreign transaction reporting, the ETE information. And so we do this at the exact exchange rate that that is required on the day of a foreign transaction. And so it seems to be a fairly unique proposition to be able to provide 2 tax packs and do it in a way that is very meaningful and beneficial to our clients. So just wrapping up from my perspective, from qualified investment and planning advice, I mean, what are the options? These are some of the individuals you may come across, whether you are a Brit or an American living in Spain. Independent financial advisors, these are typically going to be UK expats or advisors that are geared towards UK expats, have been in the marketplace for quite some time, can be a very valuable resource when it comes to structuring portfolios. You might come across bank branch employees, so your Sabadell's, Santander's, Caixa banks, individuals that can provide certain account structures, investment structures. I would say to the Americans on the call, buyer beware. The structure itself may be problematic, or the underlying may not be qualifying from a U.S. perspective. Private bankers are typically going to be, your Swiss bankers, maybe your Spanish domestic bankers would be geared more towards Spanish domestic, maybe some Latin American clients. Probably aren't going to, I don't think a lot of the Spanish domestic private bankers are going to be focused on US or UK. If they are, they will most likely be very provincial in their approach, where they're only going to be managing EU denominated assets and will be limited in their ability to manage anything in the US. Domestic financial advisors, similar to private bankers, but not necessarily working at a private bank. Again, I would offer that these individuals are going to be very focused on providing a siloed approach to just one pool of your assets. International financial advisors, this is what I would consider Diego and I to be. Although I do sit in a U.S. family office within our London framework, we're individuals that can actually manage and advise, as Diego mentioned, our regulatory approval both in the U.S., the UK, and in Spain, as well as our custody options having U.S. custody, meaning we can open up every single account structure we need to in the U.S., as well as if it's a Brit, we can do UK account structuring, SIPs, ISAs, brokerage accounts, as well as being able to open the brokerage account or investment management account in Luxembourg from an EU perspective, and then providing that through a singular global strategy across the entire portfolio. And then the last, for the ultra wealthy, you have family office opportunities, whether it's multifamily office or single family office. These are the individuals that are going to have the greatest flexibility to access certain markets and do it in a compliant fashion. But where individuals on this call don't have 100 million to be able to invest in family office, we like to think that we're a very good alternative to be able to provide a family office approach across multi-jurisdictions. And then I will leave you kind of with these questions. And as you can imagine, they all dovetail nicely into our proposition. And it's really around the ability to have a single global strategy across all your wealth, regardless of where it sits and regardless of where you sit. Our entire ethos is we believe that your wealth should be as borderless as you are. And therefore, we've put this proposition in place. And we thrive on complexity. As I mentioned, the consolidated multi-currency reporting, and then ultimately our ability to have a regulated office in the UK and in Spain, and then ultimately our ability to, like I said, manage US assets in a compliant fashion, and then our investment thesis, being global, active, direct, and long-term, and so putting a bow on what Diego said earlier, our proposition is very focused around 3 pillars. It's the strategic wealth planning, whether that is in a formalized fashion of actually doing a goal-based financial plan or a cash flow-based financial plan. It's the idea that we are very agnostic around where your wealth sits, what currency it sits in. We just want to make sure that it's in the most tax-efficient structures, location, and ultimately currency that will meet your objectives. Then our investment management proposition, again, ultimately, irrespective of what currency you need to have it managed in, we can manage it in that currency and actually have a view against the taxation of the position in the portfolio. And then the last is our reporting, and whether it's the how am I doing, having a portal that can consolidate your assets in Europe as well as the UK as well as the US. We can show all of that in one place in multi-currency, compared against the benchmark, and then ultimately providing you with those tax packs. And then I believe I'm going to hand it back to you, Diego, to bring us home.
Thank you, Todd. No, that was perfect. I think that we are more a manager than a traditional advisor. No, we manage all the relationship with the client, not only with the client itself, also with their family. That is one of our pillars of the firm. So it's good to make the intro on how we need to, obviously we need the client to know us, and we meet with our client. We review their existing affairs to handle them together with a tax advisor like Sonia, and we can make the recommendations to invest in an efficient manner, in a tax efficient manner. With my team that is in London, we set up the accounts and the investment strategy. We usually have with the client, we have a quarterly meeting with them. We see their investments, their taxation complexities. If they, for example, they're gonna move, they have to tell us, and we try to help them on all that issues. And at the end, we provide a year-end report with all the information the client needs. We say that if we solve a problem to the client, it's like for them it's a goal, no? Because we can help them on resolving the things that for us maybe it's easier, and for them it's a big case. Where we always say that there's no magic receipt. The key is trying to listen to the client, to each person, and give the time to understand their background, their expectations, the level of risk that they're willing to take. there are certain things that we need to take the time and understand each client. That is why we are very focused on the client and their needs, and we make these tailor-made solutions. I want to finish. I want to say, I think Todd mentioned everything, and Sonia was very good on the explanation on the tax ambient. That moving is stressful. I know that. I experienced it by myself, arriving to Spain with my family, and I know how important it is to have someone that can listen to you and help you navigate all the uncertainties that someone can have when moving to another country. And that's it. So thank you everyone. I don't know, Victor. I need
to throw up our disclaimer. I need to throw up our disclaimer before my compliance team, has a heart attack. Yeah, that we do not provide tax or legal advice at London and Capital. That's why we work so closely and collaboratively with Sonia.
Perfect.
A wise man. So I had a couple of questions for each of you, if you don't mind. Would that be all right?
Yeah.
Mm-hmm. Fine.
Okay. Well, at the American Society and at Metropolitan, and in dealing with my colleagues, my British fellows who have moved here, one of the things that I hear is that they may have already made a mistake. So what is the most common mistake that people can avoid making if they haven't come here, or what are things that they can do to remedy if they started to transition and they haven't done all the planning that they need to? Whether it's for getting ready to pay, or being in an official position for Spanish taxes or for the UK, US. So what's a common mistake that people made you can help them with?
Yeah, on my case, what I see is that a mistake that it's difficult to remedy, which is that they want to apply the patent regime, the Beckham Law, but they are already in the country. So they should have received an offer to actually move to Spain to work before being in the country. So then in those cases, what they have to do, if they have spent not much time in Spain, like 3, 4, 5 months, go back to your country and then just plan ahead and come because of a work reason and not because just you like the country. But that only works if they have been in Spain for a few months, but if they have already become a Spanish tax resident, that remedy is not going to work. And then I think that we discussed it, and Todd, you did a great job, the pre-migration planning, no? I think it's relevant. Try to crystallize losses, especially in the UK. They will be lost if they don't use them. No, in the US, because they keep paying taxes as a US citizen, they will be able to use their losses at least against US tax, but not for Spanish taxes. So that I think it's a very relevant point as well.
Okay.
I think from my side,
the other question I was going to ask there, Sonia.
Yeah.
Mm-hmm.
Go ahead, Todd.
No, I was just going to say, from my side, I think the most common mistake I see is the individual that comes in. We have to do a remediation effort on a lot of the PFICs that I mentioned, the passive foreign investment companies. So this might actually be an individual that has been a non-U.S. resident, so an American that's been a non-U.S. resident for 10, 15, 20 years, and they've acquired wealth and assets and built a portfolio up with maybe a local advisor. And this isn't just specific to Spain. I mean, this could be Germany, the Netherlands, the UK, whatever you have. And ultimately, we become not only the bearer of bad news from a portfolio management perspective, but then we also have to help them remediate and clean that up. Clearly working with a tax professional to get on the right side. But that's probably the most common in terms of mistakes, is getting into a punitively taxed investment without knowing it and holding it for a long time. One thing I have seen twice in the last 3 months that's worth mentioning is individuals that recently retired within the past, call it, 2 years. And in doing from the United States, in doing so, they chose to maybe roll their 401k into a Roth IRA, and so they ended up paying the taxes, thinking, "Great, I'm going to be in a Roth IRA, and not have required minimum distributions. I'm going to have tax deferred growth for the rest of my life. Maybe use this to pay, or not pay, but use this to pass on wealth to the next generation." And then they decide, after having done that, they decide, you know what, Spain looks really attractive. I'm going to move to Spain. So they did it with the best of intentions, or they did it with the best advice, but their personal circumstances have now changed. And what they've done is they have effectively lost all tax deferral from, once they become Spanish tax resident, they no longer have the tax deferral on that account structure. So it's about that idea of just being mindful of what you might want out of life and planning ahead. So
yeah, with IRS,
Okay.
Sorry, I want to add
IRS,
something. There's a lot of misinformation.
Go ahead, Diego.
No, something I want to add. There's a lot of misinformation, and that is why planning is everything. And also plan with experts. Sometimes it's better to connect with the expert that had the expertise on how to do things, that trying to Google things and try to understand the things by their own, because at the end that is much more expensive than making the things with the experts. Like Sonia.
Okay. Also, can you add some context into a phenomenon that we're seeing here in Barcelona and Spain in general? There seems to be an increasing number of properties and real estate being bought by both America, U.S., and UK nationals. Any considerations that you think from an investment management or from a tax perspective that people who are coming here should consider buying property?
Yeah, we have seen in the last few years an increase, and maybe one of the reasons was the golden visa. So it was a way to legally be able to spend time in Spain and not be limited to the 90 days as a tourist, and that gives you a residency permit. That possibility, and basically it is to buy a property in Spain of more than 500,000 euros. That possibility is still an option, but it's closing down. Already the government has announced that they want to limit the golden visas to someone that moves to Spain, and maybe, someone that wants to have the possibility to live in Spain and not even become a Spanish tax resident, investing in financial assets or Spanish bonds, but not real estate. But one of the reasons has been that, Victor, and I think, Barcelona is a popular city. There is some wealth tax considerations where basically the property is more than 500,000 euros and owned by an individual. If it's two individuals, as Todd was saying, then the exemption of 500,000 euros works for each individual. So if we have a property of 1 million, because it's going to be owned by two people, then the exemption applies to each of them. So therefore there would be no wealth tax. But there could be wealth tax, but it's going to be, I would say it should be a reasonable amount. I always say that our wealth tax is your property tax. But that's something that you want to take into a consideration if you want to rent the property, on which you also will pay taxes. So it's a matter of making sure that you understand the costs and the benefits, and make sure that that's an interesting proposition from an investment point of view. Or maybe you don't think about investment, you just want to have a house in Spain for when you come, and also have the benefit of the golden visa.
Okay. Similarly, Todd, and actually the question for all of you, if somebody would like to understand how to more effectively manage their portfolio, or lower their tax bill, be fully compliant, how should they engage with you guys?
On my side, and
I think just you can reach out to us directly. Oh, sorry. Go ahead, Sonia. Sorry, go ahead.
No.
Go ahead.
I was going to say the same thing. Reaching directly, I'm happy to have a call to understand the needs of people, just to understand what their situation is. And then from there, on my side, we will make fee proposal. We'll tell you, well, I think that we can help you in this and that, and this will be the cost. So we are very, very transparent on that. But that first introduction call, I'm happy to have it, because otherwise, I don't know what I can help. Maybe I cannot help, and then I just will find the right expertise for that.
Okay. Yeah, and I would just offer. Unfortunately, we're not we're not accountants, and we're not attorneys, so we don't have hourly rate. The only way we get paid is if we engage. So the point being is, by all means, reach out. Would love to, meet with you and learn about your situation and figure out if we can, point you in the right direction. And if we can work together, then great. And if we can't, I'm delighted just to get people good information so they can make a great decision. So, we're available, online. I'm sure you have our contact information. It may be in the chat. I don't know. But London and capital, very important that you have the ampersand when you Google search us, London and capital, and you can either you'll be able to find me quite easily with a Google search, and London and capital, as well as Diego. So.
We are happy to receive any inquiry.
Yeah.
So again, we are happy to receive any inquiry or how we manage the challenges when moving, especially our expertise on the cross-border matters. I know maybe the non-dom regime that is finalizing, or the increasing cost of living in the US, the people are thinking about moving into Spain. No?
Okay. And one last question. How do you normally deal with expats, British and Americans, who are already in country? Or I know it's helpful to get them before they're moving here with them mentality to come to Spain, but what is a profile for both of your organizations?
So we clean up the mess. You can tell that, Todd.
So I say, are most of your clients already, say, in Spain, or are they still in country planning to come?
Well, I think that Todd connection is.
I'll go ahead. Yeah.
No. Yeah, we have many clients that are moving or they are living nowadays. When we opened the office here, it was post Brexit, because we already had many clients living abroad.
And it's the case for me as well, Victor.
Yeah, and I would just, yeah. Sorry, I was just going to say that we have a number of people that are pre-immigration planning from the U.S. They haven't even actually made a decision whether they're going to fully commit to the move. In certain instances, the same goes for the UK. But given what's going on from, well, I don't want to go so far as down the rabbit hole of the political landscape, but in both countries, potential new tax legislation that is being proposed in the UK has a number of people reevaluating where they want to be in the next 5 to 10 years, as well as with the U.S. I'm seeing a number of people that are at least thinking about life outside the U.S. Going forward, and so we have a lot of individuals that are now in the process of relocating. But to Diego's point, given how long we've had our footprint in the EU. We do have a number of clients that have been in Spain for a number of years. And based on the strength of relationships that we have with individuals like Sonia, we're starting to see a lot more interest in domestic and individuals that have been in Spain for a number of years, both Brits and Americans. So.
Okay. Well, do you guys have any questions for each other? I have a number of things that you guys covered everything. Very thorough, comprehensive, I guess.
Thank you.
Intervenciones, I want to say in Spanish. But yeah, and when you talk about these things, you need to be thorough to demonstrate that you really know what you're talking about and that you're professional, and you guys did it. And so there's a lot of material that was provided, and I'd be happy to circulate this to our readers. If you have any questions, please don't hesitate. I can read these to Sonia, to Diego, to Todd, and vice versa. If you guys would like me to send it off to people who registered with us, I'm happy to do that. Unless there's anything else, I think we can wrap up. Do you have any questions, any of you?
No, I just want to thank you for your for hosting and the platform, Victor. Appreciate your support and collaboration.
Muchas gracias.
Yeah, thank you so much. Muchas
gracias.
Well,
this is near and dear to our hearts, and I really appreciate expert advice. Thank you. Have a good night.
Bye-bye.